Hello ladies and gentlemen. In this video, we are going to understand the controversy related to PMC Bank. Now, first thing first, what has happened? Actually, recently RBI, that is Reserve Bank of India, has imposed caps on, that means limitations on withdrawals made by the customers of Punjab and Maharashtra Cooperative Bank for 6 months. Now, these restrictions were imposed as per the provisions of Section 35A of Banking Regulation Act of 1949. Now we are going to cover the entire issue, but before that we need to understand what is PMC Bank. PMC Bank is a Punjab and Maharashtra Cooperative Bank Limited. It started its operation in 1984 and presently it is a multi-state scheduled urban cooperative bank. Now it is operating in Maharashtra, Delhi, Karnataka, Goa, Gujarat, Andhra Pradesh and Madhya Pradesh. PMC Bank is a scheduled bank. It was provided the status of scheduled bank in year 2000. Now let's understand the controversy. Why these restrictions were imposed? These restrictions were imposed to prevent a bank run. Now what exactly is a bank run? A bank run occurs when large number of customers withdraw their money. When large number of customers withdraw their deposits simultaneously over the concerns related to bank's solvency. As more and more people will start withdrawing their money, the chances are that bank's reserve may not be sufficient to cover the withdrawals. So that's why, to prevent the sudden withdrawal by the customers, RBI has put restrictions on the withdrawal. Now why these restrictions were imposed? These restrictions were imposed because NPA of PMC Bank increased largely. So these restrictions were imposed as a precautionary measure. The NPA of PMC Bank in 2018 was 1.05%, while in 2019 it was 2.19%. As you can see, the non-performing assets of bank are increasing. See, in simplest term, a deposit by a customer is a liability for bank because bank will have to pay the interest amount. On the other hand, a loan provided by the bank is an asset for bank because bank will earn interest on that money. So deposit is liability and loan is an asset. Now when this asset is not able to earn money, that means it became non-performing asset, then it is a problem for bank. A non-performing asset refers to a classification for loans that are in default or are in arrears on the scheduled payment of principal or of interest. That means a customer took loan from bank, but either the principal amount or the interest amount was not being paid on time. So bank will have to consider that loan as non-performing asset. I'm not explaining the concept in detail. I'm just simplifying it so that you can understand it easily. Now coming back to NPA, since the NPA of PMC Bank increased suddenly, that's why RBI has put restrictions. Another issue is that CAR, that is Capital Adequacy Ratio, also increased. Capital Adequacy Ratio is the indicator of health of the bank. In 2018, it was 12.29%, while in 2019, it was 12.62%. So because of these indicators, RBI put restrictions on PMC Bank. Another important thing is that though the auditing of cooperative banks are done by state government, however, RBI has the power to audit cooperative banks once a year. Now what are the restrictions that were imposed? First thing first, obviously restrictions were imposed on the withdrawal to prevent bank run. So during the period of restriction, the customers of PMC Bank are not allowed to withdraw more than rupee 1000. RBI has also imposed restrictions on the lending by the cooperative bank. That means bank cannot issue fresh loans. The notification issued by RBI also said that PMC banks cannot grant or renew their loans and cannot make new investments. Now one thing that should be kept in mind that RBI has not withdrawn the license from the bank. RBI has said that the restrictions will be eased according to the performance of PMC Bank. Now these restrictions were imposed as per the Section 35A of Banking Regulation Act of 1949. The Section 35A of Banking Regulation Act provides power to RBI to give directions to banks. Now, one important thing is that all the deposits of scheduled banks are insured through DICGC, that is Deposit Insurance and Credit Guarantee Corporation. DICGC covers deposits of rupee up to 1 lakh. That means saving of up to rupee 1 lakh is guaranteed by the deposit insurance. In simplest term, if bank won't pay, then DICGC will pay up to rupee 1 lakh. Now anything beyond that would be repaid depending on the recovery under RBI appointed administrator. If we talk about DICGC, it is a subsidiary of RBI. It was established in 1978 and it is a statutory body as it was established as per the provisions of Deposit Insurance and Credit Guarantee Corporation Act of 1961. The purpose of this organization is to provide the insurance of deposit and to provide the guarantee of credit facilities. The headquarters of DICGC is in Mumbai and presently RBI Deputy Governor Mr. BP Kanungo is the chairman of DICGC. So this was the entire issue. If this video was helpful for you, please share it. Thank you.